Our next guest says that history shows that if you wait too long, you might miss the better part of a rebound. Joseph Seminetta, he is the president and the CEO of Premier Asset Management. He joins us from Chicago. Joseph, welcome to the program.
Great to be here. Thank you.
Joseph, okay, we're in a bear market. No surprise there, but you've been taking a look at history and taking a look at rallies within bear markets. What does history guide you to?
Well, it's interesting. This is going to be a really horrible year for the U.S. economy. I mean, we're expecting negative, 5 to 6% GDP growth for the fourth quarter and the first quarter, and maybe a high print of unemployment of perhaps even as high as 10%. But very large structural bear markets like we believe we're in right now, a lot of big rallies can occur in that. So we look at a couple data points. One is M2 growth. When M2 has ever been higher than 15% over the last 50 years, really, the market's had a significant rally the next year. So in 1972, the market was up 30% after M2 growth was up very high. In 1975, it was up 50%. In 2003, it was up 25%. So the combination of the shock and awe stimulus and Fed easing, we think, will be very significant and can really move the market higher. The other thing I think we look at a lot is the last two periods that were closest to what we have now are the 73, 74 bust and, unfortunately, the 1930s. And some gigantic rallies happened, right after that. Unfortunately, no bell rings when the markets hit its bottom. But if you look in 74, from the lows in 74 to the highs in 75, you had about a 55% bear market rally. And then if you go back to the 1938, 39-ish, you really had about a 60% rally. The Dow went from, I think, 100 to about 160. Unfortunately, after that, you had long repair periods where you had some ups and downs. But we think a lot of the damage has been done in this market, and we've got an interesting approach to, we think, come out of that.
All right. Well, let's talk about that approach. I know that one of the areas you're focusing on is the Obama stimulus package that is winding its way through Congress. Tell us, is the stock market going to react to this stimulus package with a sustained recovery, or is this likely to be a bounce and then a bounce back?
Yeah, we haven't been big fans of the stimulus so far. Clearly, not much of it has worked to date. We think there is a point where all the pressure building up in the system. We've seen some improvements, right, in credit. You look at the commercial paper market, that's improved. Some other things have improved. We think it will have an effect, but when it actually starts, no one knows. I actually think in the market we could have a good 25% rally this year. The problem is I don't know whether that's in March or in May or in September, October, but at some point the stimulus is going to push through the system and create some activity in the markets. We have a three-pronged approach right now. We're a large cap growth manager. And I think it might surprise some people what our approach right now it requires a lot of nimbleness and perhaps rolling with the markets that we're given, which aren't the ones we choose. So
well, tell us, if I can, Joseph, tell me,
sure.
Give us at least one of those approaches, one of those things, those criterias.
Sure. One of them would be dividends. So dividends is an example. Large growth managers generally don't pay attention to that. We think people are so starved for income-producing assets now that dividends are going to matter again. That we're looking at solid companies, not financials or autos, that are yielding 6, 7, 8%. But essentially, we think are very strong positive cash flow companies. And if the market goes back down again, that'll save the stocks. And if the market goes up, we think we can get 10 or 20% in the name plus a 7 or 8% dividend yield. And we think that's very attractive.
Joseph, just stay with us. And obviously that dividend comes with a 15% tax if indeed you hold it for the required holding period. Up next, we're going to have more with Joseph Seminetta. Also, in about 10 minutes, we're going to talk to the CEO of the best performing insurance stock over the past year. We're going to introduce you to the stock and their perhaps unique business. Well, we're coming back in 2 minutes. This is Taking Stock on Bloomberg. Well, we were going to listen to President Obama, but instead we're going to talk to Joseph Seminetta. We're going to talk a little bit more about the stocks, the growth profile that he uses in order to determine which stocks to consider. Now, there are two other elements, Joseph, that you wanted to mention. Go ahead. You talked about dividends.
Yeah, one is trading ideas. We've been doing this for a long time where if you have stocks you really know well, Apple is an example. We started buying that back in 2002, and we bought it single digits, we sold it at 170, we bought it back at 80, and we think looking at history again, looking at 38, 39, going all the way to World War II, looking at 73, 74, going into the 80s, what you're really going to see is after the recovery happens, then you have a long repair period, and active stock selection really pays off in that period. The indices don't do much of anything. They kind of trade up and down. But so trading ideas around, I think, is going to be key to making money in this period.
What's the third item? Yeah.
Third item is really just the high-quality growth companies that we like to buy. And, we like to, like Benjamin Graham says, you're getting A-plus companies at cigar butt prices. So, the Googles of the world, the strong free cash flows of the world that we're getting them at multiples that we've never seen before. So even though we're a growth manager, we sure like to buy the best prices, the best stocks when they're priced well and on sale. And that's really the case right now.
All right. Well, Joseph, let's talk about some specific stocks that illustrate your technique. Let's start with Verizon. Now, Verizon, you're using that to illustrate the dividend portion of your strategy?
Correct. I mean, Verizon's paying, the stock hasn't moved in a long time. I mean, it's moved up and down, but it's basically to a 6% dividend yield and a 12 PE. So you're getting paid to wait around. This is a company with, an $86 billion market cap, but $100 billion in annual sales. So this isn't a deeply cyclical company or a company that's not going to be forced to cut their dividend. We think they've got a good growth strategy as well. Their wireless is benefiting a lot from the demise of others, such as Sprint. I mean, you've got
but let me ask you, Joseph, just to clarify. I mean, when we took a look at the most recent Verizon report, they said subscriber growth in wireless was not as great as everyone had expected. As I'm sure you know, the decline in wireline services, and they're pouring a lot of money into the new Fios, the new fiber optic system that's supposed to deliver television and all sorts of internet-based programming to the home. Is it possible that these telco companies, while they look safe, they're facing technological challenges ahead?
It's always a challenge. I think they're the strongest of the group. As the Sprints back off and some of the weaker competitors get weaker, we think they'll be one of the survivors. The Fios is very interesting. Fios is like a bundled service, right? They have you get internet, you get high definition TV and phone system, and the high def, is 100 channels, increased quality, and so forth. It's been very successful out east. We think it works long term. The wireline business is by trying to bundle it. It's not a news story, but it's one. Again, $100 billion a year in revenue. We think that can stay a long way to keep that dividend play very safe. It's not our most. Yeah, it's not our most attractive growth idea. But.
Okay, so Verizon for the dividend. I just want to be able to get all these in. Verizon for the dividend. Tell me about Fluor. This is another company that you're following and that you like to buy. Tell me why.
Fluor, again, I think is part of Obama's stimulus plan, and this is really one of 3 international companies that can really bid on almost engineering and construction, project in the world. I mean, tremendous quality. It only is a $7 billion market cap because the stock's going down so much, with $21 billion in sales and a $36 billion backlog. We like the areas they're in. We think actually in terms of trading, energy, industrials, materials are the real companies, but are the sectors, I should say, that are really going to do well because they've fallen so far. The stock's 60% off. It's deeply on sale, and we think as a trading idea, this could have a big pop.
Let me ask you about Fluor, though, because a lot of their business is tied to the oil business. What about the fall in the price of oil? For example, they do a lot of work in the oil sands. You need a higher oil price to make a lot of that economic. They have not had any major cancellations of projects, although there have been some delays in
priced in. I mean, you're seeing a lot of their deals were done at $50 to $70 oil, and most of their customers are fairly well heeled with not difficulty, at least at this point, accessing credit. So I think that's very well discounted in the price of the stock, and at 60% off, I think it goes higher from here.
Okay, let me ask you about Google. This is the third name that you've been buying. Tell me about Google.
I mean, Google, you couldn't design a business model better than Google's, really, from our perspective, for the type of traditional growth stocks. Growth managers have really had to adjust their philosophy the last few years because, what's growth and what's not growth. I mean, Google has really done a fabulous job, they've benefited from the secular trend of ad dollars moving from traditional media to the internet. Their applications are really giving Microsoft a difficult time, the Google apps. The things where they don't need to share revenue are really doing well, the maps, the Gmail accounts, and so forth. And I think what's impressed us most about Google is, the stock is half off, and they've really been able to cut expenses. I mean, we didn't really know whether, Google, transgresses to the new company that it's going to become. They've been very aggressive at cutting costs, and we think they can do that further. And we think they're in a sweet spot.
All right. Well, we're going to have to thank you very much because we're out of time right now, at least for this conversation. Look forward to having you back. Joseph Seminetta, the president and the CEO of Premier Asset Management. When we come back.